This video is an uncovered Japan company research report on Seika Corporation, ticker 8061. Seika is a Mitsubishi Heavy-affiliated Japanese machinery trading house with a portfolio spanning energy, industrial machinery, and semiconductor-related equipment. The starting snapshot is unusually strong for a machinery trading house. As of the report date, Seika traded on a forward PE of 14.1 times, delivered return on equity of 14.84% in fiscal 2026, and offered a 3.12% dividend yield. The important caveat is valuation. Its forward PE sits above the 10 to 13 times range of its machinery trading peers. A specialized Japanese shosha is a technically literate middleman. Seika holds import agency rights for specialized overseas industrial equipment, matches it to a customer's operating problem, helps integrate the solution, and services it over time. The high-value part is the technical proposal and the long after-sales relationship, rather than the physical movement of a box. Seika's three segments are central to the investment case. Energy, roughly 40% of sales, supplies power generation and decarbonization equipment, including hydrogen and ammonia opportunities. Industrial machinery, around 35%, serves the manufacturing capex cycle. Product, about 25%, includes semiconductor production equipment. The spread is real diversification, though fiscal 2026 also benefited from all three tailwinds blowing together. The 5-year profit record is stronger than the sales record. Revenue rose from 85 billion yen in fiscal 2022 to 108.5 billion in fiscal 2026. Operating profit climbed from 3.5 to 8.0 billion yen, while net income rose from 2.4 to 5.6 billion. That profit-led progression is why Seika's return profile has moved to the top of its peer group. From fiscal 2022 through fiscal 2026, revenue compounded at roughly 6.3% a year, while operating profit compounded at roughly 18%. The operating margin almost doubled, from 4.1% to 7.4%. The report identifies this as a genuine step change in earnings quality, but notes that the much larger asset base built through acquisitions and investment still has to prove its returns. Seika's moat is not scale. It is a dense network of exclusive agency contracts with specialized US and European equipment makers paired with customized proposal engineering and after-sales support. Mitsubishi Heavy affiliation can enhance credibility and access in conservative industrial and utility markets. The counterweight is dependence. A maker can potentially sell direct, so Seika must keep demonstrating why its engineering and service are worth the intermediary margin. The earnings progression was not confined to operating profit. Net income tracked upward as well, reaching 5.6 billion yen in fiscal 2026, alongside operating profit of just over 8 billion yen. That produced 14.84% return on equity. Investors should nevertheless watch the balance sheet. Total assets expanded by 52.5% year-on-year, reflecting new subsidiaries and heavier investment. Management's playbook is coherent. Deepen the Mitsubishi Heavy relationship, expand decarbonization and hydrogen-related products, benefit from Japan's semiconductor fab build-out, add agencies and acquisitions, and extend the service tail. The report also makes the risks explicit: trading house disintermediation, dependence on foreign makers, foreign exchange exposure, and the limits of a Mitsubishi-affiliated board all matter to the durability of the thesis. Capital returns are steady rather than spectacular. The report describes 5 consecutive dividend increases, a payout policy of about 35%, and buybacks that bring the total return ratio to roughly 40%. Seika's 3.12% yield screens around the middle of peers. That makes the income case credible, but the dividend is earnings-linked, rather than an untouchable progressive promise. The report own 3-year scenario range is deliberately wide: 1,400 yen in the bear case, 3,150 yen in the base case, and 4,500 yen in the bull case, against a then-current price of 2,980 yen. This is not a price target or a recommendation. It is a framework showing that execution, valuation, and the direct sales threat will determine the outcome. In summary, Seika is a well-built industrial intermediary with a genuine agency and engineering moat, and exposure to decarbonization, semiconductor investment, and industrial capital spending. Its recent financial progress and returns are impressive, but the stock already prices in continued execution, while disintermediation, maker dependence, and volatile share supply demand remain material risks. This is background research, not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.